Okay, great. So I want to just welcome everybody to our October meeting of the Central Florida Options Group. We're also merging in with Eric's group. So I want to welcome anybody new to the group. And if you guys have questions throughout the presentation, either just speak up, or if you want to type in the chat, that's fine as well. So, and hopefully this will be pretty interactive. So if you have questions, feel free to bring them up. So hopefully you can see my screen. This is bearish trade strategies. Everybody?
Yes.
Okay, perfect. Thanks. So I guess the question, pretty obvious question, when should we add bearish trades to our portfolio, or, trades that we're making on a regular basis? And, there's several reasons. One, if we feel either an individual stock or an index is overbought and we feel it's due for a pullback, that's a perfect time to add some kind of a bearish strategy in. Another is when you just feel like the whole stock market is in a correction, and that we could see a significant downturn. We want to make sure that you consider adding some bearish strategies. And another reason, even if the market isn't in a bearish pattern or a correction, you might want to use some bearish strategies just to hedge your portfolio. For example, if you just want to make sure that if the stock market does pull back on even if it looks bullish, that you don't, you protect your long positions. And then the last reason that I could think of was if you have some long-term stock positions that you don't want to put a stop loss on because maybe your basis is very low and you would take a big tax hit, you can use some bearish strategies to reduce the risk of a downside there. So those are some reasons that I came up with. And it's always good, to have more of a delta neutral strategy when you're trading options, or at least some degree of, bearish positions. So I wanted to go over a couple of the kind of real basic bearish strategies first, and then I want to talk about a strategy that I really like using for a bearish position. So the first one, and probably anyone that trades credit spreads knows that you can do a bear call spread, which means it's a credit, you receive a credit for the risk. And what you're doing is you're selling a call or a call spread above where a stock or index is trading, so that if the stock pulls back, that call spread will be profitable to you. So just a really quick example would be on SPY. If SPY was trading at 435.26, I must have wrote that down today. If you sold the December 455, 460 call spread, and you would collect $1.02. So in that trade, you're actually selling the 455 and buying the 460 for a net credit of $1.05. So your maximum return on risk would be about 25%, which would be the $102 that you would receive per contract divided by the 398 risk. So, and so the good part about that is, you already received your credit up front. You kind of know what your maximum risk is, and you can manage it, accordingly from there. So any questions so far on that strategy?
No.
Okay. Okay. So, and then here's just a screenshot of what that trade would look like. So you would, this on the left side is your call side for those that are, and you would sell the 455 and you buy the 460, and your credit would be $1.02. And over here it shows you your maximum risk, and it also has what's the problem. Our Tastyworks will show you their analytics that shows what's the probability of profit at 50% and probability of profit. But the key thing is, how that trade is set up. And so it has a negative delta here, which is what you're really looking for when you're adding in a hedge position. You want to try to not negate all your positive delta, but just add some in there so that if the stock market does pull back, then all of your positions aren't taking a major hit. So that's what it would look like for a call spread. And we all probably do that. And RJ said that Eric is fond of deltas. Is there a delta you like for bear spreads? I would say it really kind of depends on how far you think that stock is going to move in that period. And so I probably tend to be a little bit more conservative and would trade somewhere between the 20 and 25 deltas where I generally lay. And what I also like to do is look at what's the expected move of the stock. So I want to make sure that I'm selling a call that's beyond the expected move, because that, statistically it should move up to that level, but not beyond during that time. So in this particular case, it's 24 is the expected move, plus or minus. So if you add the 24 plus 435, it comes up to about 450, and I chose a 455. Does that make sense? Did that answer your question, RJ? Okay, so the other strategy, and this is another really common strategy, it's a bear put. And that simply is buying a put or a put spread. And so interesting about a debit put spread is that you really benefit in two ways. One is if the stock moves down, your put is going to be worth more than what you bought it for. And also, if the stock pulls back, volatility will probably most likely increase. So your price of your option that you bought will go up when the stock moves in the direction you want it to go and IV increases. So just a quick example of this type of trade would be SPY again, just to buy the December monthly contract that expires on December 17th, and you would buy the 435 put, generally at the money, but you could use different strategies, and then sell the 425. So you have a $10 wide spread, and for that you would pay about $3.18 or $318. And the good thing about that is, immediately, instantly the most you can ever lose on the trade. So if you invest $318 and the stock and the market goes down and SPY goes down, then the trade is going to be profitable. And if it isn't profitable, then the worst case would be you'd lost $318 per contract. And so the reward would be $682, which is simply the $1,000 for the $10 wide spread less the $318 that you paid. And those are pretty common. A lot of people do those. And here's what it would look like on the options chain. So you would be buying the 435, which is basically at the money, and selling the 425. And again, it shows you, what your maximum loss is, what your maximum gain is, and what's the probability of profit at 50%. So, so those are two ways that you can, hedge or put on a bearish trade. What I wanted to share today is a strategy that I've done for a while, and it's a bear leap trade. It's a long diagonal put spread. So the way it kind of works is you would buy the long dated put, and then you would sell sell puts against it to reduce the basis. and you will be profitable if we can sell that put for more than what we paid for it. And here's an example of a trade that I did using this strategy, and then we'll go into more detail. So on 9/21, I bought the December 365 put, and I paid $15.91 per contract. So $15.91, and at the time the stock was selling for $366.85. At the same time, I sold the 9/24 355 put, so another $11 below where it was trading, and I collected 97 cents, and that would have reduced my basis down to $14.94. That expired, and then I rolled it to a 10/1 358 put and received another 83 cents. So my basis in that position is now down to $14.11. The stock pulled back, and I was able to close out the entire position, long put and short put, for $18. So if you take the $18, subtract the basis, we had a $4.54 profit per contract, or about a 28.5% return in 14 days. Now, they all don't happen that fast, and sometimes you end up writing a lot of puts to reduce that basis, but that's a real quick summary of an actual trade. So any questions on the mechanics of that or anything so far?
You're selling weekly puts against it, like
Yes.
about 2 weeks out. Is that?
I was selling them every week.
Every week.
Mm-hmm. And I generally use about a 20 delta. And but I generally look, what is the expected move over that week, and then sell beyond that.
Right.
Hey, Brian, I think when we were speaking about this before, you called it a poor man's covered put. Is that right?
It is, yeah. I mean, a lot of people, are familiar with a poor man's covered call. This is kind of, some people refer to it as a poor man's covered put. And it's also, it does require money. So that's one of the reasons I don't like to call it a poor man put, because I mean, it does take, $1,600 per contract investment. So, but it's cheap, but it's cheaper. But it's cheaper than, okay, hold on. Let me stop this share, and I'm going to go ahead and mute everybody. So,
yeah.
Okay. Sorry about that. And if you guys have any questions, just raise your hand and I'll unmute you. So I don't want to have everybody not talk, but that background noise will drive everybody crazy.
I had a question, Brian. I'm not as familiar with, I mean, I'm more familiar with call diagonals, but so in the case that you, that the market did, head lower. So if you bought the 365 put and you sold the 355 put, that was your starting position. And the market actually went down to 355. Does the, is it similar to a put debit spread? And because in a sense where the width of those strikes is what you can like max gain during that cycle, what your max is it?
Yeah.
I don't know if I'm asking that right.
No, I mean, that's a great question. I don't know if it's that clear, because like when the stock went from 366 down to 355, you would, have an 11-point gain. And if you bought the 50 delta, you'd probably make like $560 on your long call, if that makes sense.
So it's a, you end up with a negative delta position.
You do.
You do at the beginning. So no matter how far it goes, you're covered. And I mean, at some point, well, once you get down to 355, you probably stop
Yeah, I mean,
making money, but you would
right.
just close both of them at that point, right?
That's exactly right. So,
okay, that makes sense.
You know, one thing that's kind of important to note on this strategy is, you know, like on a covered call, if you buy the stock and you sell the call, they just take your shares away. This is two separate trades. So you have to execute both of the trades. You can't just assume that if it dropped down to 355 that they're going to take your long put away. So you just close both legs at the same time. And to your point, Eric, if the stock did drop to say 350, you would close both legs and the trade should be pretty profitable. But it's more profitable if you get, you know, stay close to that 355 level. Because
right.
once you drop below 355, that, you know, that short put starts losing money. So you want to make sure that you know, you sell a put far enough out that you don't think it's, you know, you don't want to sell a 30 delta on this put spread.
Interesting. Yeah, cool.
Anyway, so let me just look. There was a couple questions. Does the broker automatically recognize that each sold put is protected by that? I believe so, Tim, because when you buy the that long put, it allows you to sell short puts against it. So, and then the other question that somebody had, okay, somebody already answered that. So, so the, you know, the goal is really twofold. We want the stock or the underlying that we wrote the put to go down. That's the best way to, you know, to be profitable. But if it doesn't go down immediately, you're able to continue to sell puts against it to reduce your basis. So it's a nice hedge, and it keeps reducing that 1591 down, you know, further and further down. Does that make sense, everybody?
Yeah.
Okay, so, you know, just some textbook stuff about, you know, what is a LEAP? It's basically just a long-term equity anticipation security. And, you know, you can do a LEAP as far out pretty much as you want. You know, there are 1 year, 2 year LEAPs. So if you were just, you know, from a bullish standpoint, if you were bullish on an overall index and you said, I think the SPY will be up at the end of the year, you could buy a LEAP and it would function as a, you know, some kind of a synthetic stock. But you're able to sell calls against it, and which is a pretty cool feature. And so anyway, so the reason we would consider doing one of these bearish LEAPs would, you know, if we're just same reasons that we would do any other bearish trade. We're either bearish on a particular stock or ETF, or if you just want to hedge your portfolio, you know, and some people, you could buy puts on, you know, the SPY or SPX. In this trade, you could actually, you know, initiate a long diagonal put spread. And you could do it on SPX if you want to, and you could do it pretty much on any where they sell options. And and the other thing, by selling the puts against it, you're able to further reduce the basis in the long put that you bought. So if it eventually, you know, it may not go down immediately like you were thinking, but if at some point it does go down, then the trade should end up being profitable. What other questions does anybody have? What do y'all think of this strategy? Do you like it, or is it something you'd be willing to try?
Yeah, I would try it. I guess I've I've been burned so many times on the short side that I'm like hesitant to do something like this. But I guess it kind of made sense. I mean, in hindsight, right? Seasonality in September played out pretty negative this year, and we're, maybe gonna find some footing here in October. But so it kind of made sense that if you were expecting, I don't know, maybe an election or like some situational sort of thing that you could put something like this on, because to sell the out of the money credit spread is the call spread, the risk reward is dangerous, because if you rally, which in many cases that happens, and the first example you gave with the SPY bear call spread, you're selling for $1, you're risking $4,
right?
And then you would have to kind of deal with that. So the in my opinion, the bear call spreads don't provide that much of a hedge. It's very minor, because if you do get the drop, it's going to go to zero, and then you're no longer hedged. So I think this is interesting. I would want to bring it up in the risk profile and really kind of see what that looks like. I'll have to do that, but
sure. I'd love to see. Yeah. The other thing that is interesting about this strategy, that theoretically you can write off almost the entire basis of your long put. If you write calls and keep selling the puts against it, then you would be able to theoretically reduce that 1591 down to a minimal number, maybe even zero. I had it wasn't a put, but it was a poor man's covered call on gold. And I wrote enough calls against it to reduce the basis down to zero. So that's another kind of reason I like the thing. You can really kind of, chop away at the basis by writing puts against it. So, and in terms of what delta to use, I tend, you could do it. I've seen it a lot of different ways. I've seen people write, 25 and 30 delta, and then sell calls against that. And there's a couple of advantages to that. One is the cost to put that trade on is minimal. Except what I found is that when you try to write puts against it, sell puts against it, what happens is the broker will assign, take a bigger buying power reduction if your delta is lower. So, and you can use a 50 delta, and they don't take any extra buying power than the cost of the put. And if you go to something like a 70 or 80 delta, you take it costs a lot more, but you take a lot more advantage of the drop, kind of like an 80% of the drop versus 50 or say 30. Does that make sense? So I've done the 30 delta, and it works really good, except it does take a lot of buying power reduction out of your portfolio.
Hey, Brian, I'm wondering if there's any tax advantage with these like 12-month leaps. If do we have long-term capital gains on the leap, and in the short-term capital gains on the short side?
Yeah, I would think if you held it for more than a year, that long put, when you sold it, would be subject to either long-term capital gains or long-term capital loss. The other interesting thing, if you did this on SPX, then you would always be eligible for those the 1256 tax handling. So it would all be handled 60% long-term, 40% short-term. Did that answer your question, Lee?
Yeah, I think so.
Okay, cool. All right. So in terms of the mechanics of the trade, again, it functions a lot like a covered call or a poor man's covered call, except in reverse. That make it simple. So it really starts with, once you have a thesis in, a stock or an index, or you just want to hedge, you would look to buy a far dated option. And that's going to function pretty much as you're short the stock. So you're going to buy the put, and you could use, 90 days, 120 days, 180, however long you want to hold that. And I tend to go out about 90 to 120 days. That's pretty much where I go. And then I start selling weekly puts against it. And the way I look at doing it, I look at, what the expected move over that 7-day period. And then I usually do 1.5 to 2 times that. So I'm selling somewhere between a 12 and a 20, or 12 and an 18 delta. So you just continue to write that, that put, you write puts. And then when it gets to about 80, if I've collected 80% of the credit on that put, and it doesn't look like my long put is going to hit my profit, I will roll it out and collect more credit. So that's generally what I do. And I tend to exit the position when I make between 30 and 50% profit on the trade. And you can definitely continue to reduce the basis in that long put. Any questions there? That made sense?
You got one in the chat from Bud.
Okay. Bud said he struggles with the statement I always hear, the most you can lose. It seems to me like some of the examples, I lose more than that. Does that make sense? I mean, I think this strategy, any debit trade should be the most you can lose is what you paid for it. Now, in this case, sometimes the short put if the stock goes through your short put, that short put will start losing money. And if you let it get too far beyond that short put, you could lose more money than the debit if you didn't manage it properly. But that would be the only thing in this kind of strategy that I can think of. And, a lot of people, like the strategy, a lot of people don't like it. And one of the feedback that I hear, people who don't really like it, is that it's pretty intense. You're handling weekly options and you're rolling them and you're reducing the basis. And you can always go further out and just sell monthly options if you want to. So that's another kind of twist on the strategy. Here's another quick example. SPY was selling at 431.93. We bought the December 432 put, so that'd be about a 50 delta, and we paid $18 for each contract, and it expired in 86 days. We sold a 420 put that expired on 9/24 and collected $2. So one way of looking at it is, what is the return on that short put? And so it'd be about 11% in that one period. And a move from 432 down to 420 would be about 12 points at a 50 delta. Your long put would be worth about $6 more than you paid for it. So that's kind of how the numbers work on these strategies. And again, they don't always work as quickly as 1 week or 2 weeks. Sometimes you might have this thing for several months before you pull it down. But the key is to continue to reduce the basis by selling puts against it. And I think it's a great hedge to an overall portfolio by using either like SPX or SPY or the Qs or something like that. So our goal is we want to make a profit when the stock goes down or the index goes down. It's a hedge against our bullish position or our overall portfolio. And this strategy is probably one of the few where you can actually generate credits along the way to reduce the basis in your long put. So that is the poor man covered put strategy. So, and with that, I have covered all my slides. So any questions people have about the strategy or just anything in general?
I guess this isn't something you'd really want to do on an individual stock during an earnings period, because you could go in and out of contango while you're rolling through the short put.
Yeah, I'd never thought about trying to do it during a through earnings, but I think it would be I think if you were really bearish on that it was going to just do terrible during earnings or through a couple of earnings, you could try it. But I tend to do more on the indexes for the bear trades. And Tim had asked, why not one 90-day vertical? Is it because the short dated credits add up to more? And yes, that's exactly right. By selling those weekly calls, and sometimes you can sell weekly puts, I'm sorry, you can sell 2 puts in actually 1 week. So if the stock goes up and you're at 80% of the credit, you can roll that trade, an additional time in the week, or roll it out to the very next week. So that's the reason. It just adds up through time. If you figure you have a 90-day period and you divide that, by 7 days, you have about 12 periods to write puts against it. So you can figure if whatever you're collecting on an average, 20 delta put, what you're going to be able to write off in that 90-day period. Since you are trying to collect premium, can you sell calls against the long put to reduce, would it limit your profit? I've never done that, RJ, sell calls, because then it's, it's probably a way to generate additional credit, but I just haven't looked into it into too much detail. Any thought, Lee or Eric, on that?
Selling.
I
don't see the question in the.
Okay, I'm sorry. It says, since you are trying to collect premium, can you sell calls against the long put? It would also not limit the profit. So would it also limit the profit?
Sometimes it's just hard to see what that looks like in the parity chart in your head.
Yeah. So typically when I don't know about diagonal kind of format, but when you sell a call and buy a put, that's typically a collar trade.
Mm-hmm.
And that's usually something you may want to do when you are holding a stock around earnings.
Yeah.
And you just want to hang on to it. You can sell an out of the money call because you're covered, but then you buy a put with that credit, and then if the stock drops, you have some protection, and you close it afterwards. And
Right.
I mean, you do limit some upside, I think, as well. But from like a rolling diagonal kind of covered thing, I don't think it would work like that. But
yeah. I mean, it's interesting. I just don't know either. And one other thing that I didn't mention is, you mentioned it, Eric, you can also roll your long put out. If you get to the point where you're like a month away from expiration on that long put, and you still feel your thesis is correct that it's bearish, you can look to roll that long put and say out 60 days or another 90 days. And one way that I look at it is, I calculate the cost of that roll, and then I kind of calculate how much I would be able to collect in short premiums by selling puts. And if it pretty much is about the same, and I'm still bearish in the trade, then I might do that and roll it out and collect more money and give it more time to prove me right.
Gotcha.
And, Rob had asked a question, most brokers won't let you sell calls unless you own the stock. You can actually, on the poor man covered call, you can own the long call and sell calls against it. I don't think they're going to let you if you own a long put. You won't be able to sell calls. It'd be considered a naked call.
Yeah.
Okay. Well, I hope this has been helpful for everybody. If anyone has any addition, I know we did it pretty quick, and we'll get the recording out to everybody. If you have any questions, you can reach out to me or Eric, and we'll try to get you an answer. And we'll get the recording out as soon as we can get it processed. So any suggestions or recommendations for a topic for next month's meetup group? Anything anybody really wants to see?
Yeah, let us know. We're always kind of, I mean, I can just talk about SPX some more if you guys want.
Yeah.
I thought, Brian, about going back to some more basic, what a put credit spread is and things like that. Sometimes, maybe the last few are a little bit more advanced, we're doing leaded strangles and, this type of stuff's a little bit more involved, but I'm not sure if I'm looking at all the names and I feel like most of the people on here probably know, but would you want to go back and revisit sort of basic mechanics of strategies for discussion, or do you guys want to do more market analysis, like current market stuff, and we can get opinions on that? Or, I mean, we're open to whatever. We don't want to bore you guys with if you already know what a put credit spread is or whatever, but or we can do technology, different software and things like that. So let us know.
Okay. Yeah, some people said, unbalanced butterflies, strangles, and straddles. We did strangles last week, but I think maybe what some technology might be that's a great suggestion. Like what things do we use or have used that we found to be very helpful? I think that'd be really good. What do y'all think of that?
Yes.
Okay.
Yeah.
Okay.
And
go ahead, Bud.
I was going to say, I don't know if we've embraced the selection process of stocks or indexes in a while. How do we select the individual stocks?
Okay. Yeah. So we could even use whatever different kind of screening technology is out there that might help us along that way.
All the reinforcement is good.
Yeah, thanks. I'm going to go ahead and stop the recording here just so I don't forget.